Hi, this is Kevin McSweeney, Portfolio Manager with CI Global Asset Management, talking to you about the CI High Income Fund performance for the third quarter of 2021. Consistent with what was happening in the broader markets over the third quarter, we saw positive returns among our securities, but at a significantly reduced pace from the first half of the year. This was largely due to macroeconomic concerns, which included pressures from potential withdrawal of monetary stimulus from the U.S. Federal Reserve and other central banks, fears that the economic recovery would slow down due to supply chain pressures, or perhaps the Delta variant of COVID. The fund felt these concerns, and in a risk-off part of the quarter, the US dollar appreciated, causing some losses on our currency hedge positions, but these have reversed early in the fourth quarter. One highlight of the quarter was the fund's energy exposure, particularly our energy infrastructure position, which registered strong returns and contributed the most of any sector. Over the quarter, as global energy prices headed higher, companies that transport energy like Cheniere Energy and Enbridge, as well as producers like Royal Dutch Shell, saw their share prices move upward alongside the commodity, and these holdings helped the fund's return. The fund's overweight position in financials was also accretive to the returns, and it also provided above-average dividend yields to support the fund's distribution. Industrial companies also rallied, with transport companies seeing stronger traffic and the fund benefiting from a takeout offer for Sydney Airport, in which we have a substantial position. Equity selection was strong overall, with 8 of 11 subsectors and each of our 4 largest investment sectors providing returns above benchmark. The fund's credit investments continued to generate attractive yields in line with expectations. Within our fixed income book, the fund has a much smaller exposure to interest rate increases that challenged other traditional bond portfolios. And if expectations for interest rate increases are borne out by future developments, the fund should continue to be able to protect value more than many of its peers. Overall, we remain constructive on equity markets due to the reopening trade and a release of pent-up savings while monetary and fiscal stimulus continue. This should continue to give some support to security prices and allow us to deliver on client expectations for long-term returns. I thank you very much for your time and interest. This has been Kevin McSweeney with CI Global Asset Management.